Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Ascentage Pharma Group International Annual Report. Ascentage Pharma Group International is a clinical-stage biotechnology company that develops innovative therapies for various diseases. The company's primary focus areas include cancer treatment, with several product candidates targeting specific types of cancers, such as BCR-ABL mutants, hematologic malignancies, and solid tumors. The company has developed multiple product candidates, including HQ-PON-1351, APG-2575, APG-115, and APG-1252, which are designed to target various cancer-related proteins. Additionally, Ascentage Pharma is developing APG-1387, a small molecule inhibitor of apoptosis proteins for advanced solid tumors and chronic HBV infection. Beyond its product development efforts, the company is also involved in medical research and development, clinical trials operations, and venture capital investment. It has collaboration relationships with biotechnology and pharmaceutical companies, as well as research institutions, to advance its research and development goals. Furthermore, Ascentage Pharma provides a range of services, including rental of buildings and provision of science and technology promotion services. The company's expertise in the field of cancer treatment and its innovative approach have positioned it as a key player in the global biotechnology industry. Ascentage Pharma Group International market capitalization of $17 billion is materially smaller than most of its industry peers of roughly $26 billion. Ascentage Pharma Group International trades at a higher price-to-book ratio of 20.93 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 90% of total assets. This elevated debt level warrants heightened caution, as it may limit the company financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. On the growth side, the commercialization of olverembatinib and lisaftoclax in China has been a significant contributor to revenue increase. The approval and launch of these drugs have led to substantial sales, with olverembatinib experiencing an 80.6% increase in product sales from China. Additionally, the expansion of NRDL coverage for olverembatinib has made the drug more affordable and accessible, resulting in a significant boost to revenue. Furthermore, the increased number of hospitals where olverembatinib is on formulary has also contributed to its growth. The approval and marketing authorization of lisaftoclax in China have paved the way for commercial sales, which have generated an additional RMB 70.6 million/$10.1 million in revenue. On the other hand, the primary drivers of revenue decline are largely attributed to a decrease in intellectual property revenue. The expiration of an exclusive option agreement with Takeda has resulted in a significant decline in intellectual property income, from $678,415 in 2024 to a negative value in 2025. This decline has had a substantial impact on the company's revenue, underscoring the importance of maintaining strong intellectual property rights and agreements. The financial health of a company can be gauged by its ability to generate positive operating cash flow. This indicates that the company's earnings are sufficient to cover its operational expenses, allowing it to invest in growth initiatives or pay off debts. According to the provided information, the company is indeed generating positive operating cash flow. This is confirmed on page 53 and page 57 of the financial reports. The generation of positive operating cash flow suggests that the company's business model is profitable and sustainable, enabling it to meet its financial obligations and invest in future growth opportunities. This positive trend bodes well for the company's long-term prospects, as a consistent stream of operating cash flow can provide the necessary funds to drive expansion, pay off debts, and reward shareholders. The company's debt level and interest expenses have undergone significant changes in recent years. Initially, it may seem that the debt level has increased, as indicated on page 28, where the debt rose from RMB 779,062 to RMB 1,222,481. However, a closer look at other financial statements reveals a more nuanced picture. On page 45, unsecured bank loans decreased significantly, from RMB 278,070,000 to RMB 140 million. Furthermore, current and non-current liabilities have increased, but this can be attributed to various factors, such as changes in accounting policies or business operations. Therefore, it is difficult to make a definitive conclusion about the overall debt level. In terms of interest expenses, there is clear evidence of a decrease. On page 3, interest expenses decreased by RMB 10.4 million, 16.1%, to RMB 54.1 million. This trend is consistent across other financial statements, including page 41, where finance costs, interest expenses, also decreased by RMB 10.4 million, 16.1%. Additionally, total interest-bearing debt decreased by 14.3% on page 29. In conclusion, while the initial data may suggest an increase in debt level, a more detailed examination reveals that certain aspects of the company's financials have improved, particularly with regards to interest expenses. Management at Ascentage Pharma is optimistic about the company's outlook and strategy. They believe that the company is on a transformative path to becoming a global leader in innovative hematology-oncology treatments. The approval of lisaftoclax has demonstrated their ability to execute their overall strategy, which aims to transform the treatment landscape for certain types of cancer. The company sees a large potential market size for oncology drug products, estimated at $166 billion by 2035. To capitalize on this opportunity, management plans to develop and commercialize novel therapies that address unmet medical needs in cancer. This includes developing differentiated protein degraders with superior profiles, targeting traditionally undruggable proteins, and expanding the product pipeline through collaborations and partnerships. In terms of commercial growth, the company will continue to drive expansion under its dual-engine strategy, which involves increasing hospital coverage and nationwide penetration. Management is also focusing on becoming a leading global biopharmaceutical company by completing registrational trials for key products, advancing commercialization in China, and expanding hospital coverage. Overall, Ascentage Pharma's management is confident about the company's prospects, with plans to gain significant market share of the global CML market and achieve revenue growth from $12.3 billion in 2023 to $14.6 billion by 2035. There are no notable acquisitions or divestitures to report in this summary. According to the information provided on page 43, there have been no material acquisitions made by the company. Similarly, there have been no significant divestitures, as it is also stated that material divestitures, none. This indicates a stable and unchanged financial landscape for the company. The company's financial performance for the year ended 31 December 2025 reveals some key points regarding its dividend and share buyback policies. Notably, the company did not pay any dividends during this period. On the other hand, it has been actively buying back shares, as evident from the treasury shares held mentioned in Note 8 of the financial statements. This indicates that the company is focusing on returning value to its shareholders through share repurchases rather than dividend payments. Concerns have been raised regarding inventory buildup in recent years. One indicator of this issue is the increasing cost of inventories sold. According to data, the cost of inventories sold rose from RMB 27,031 in 2024 to RMB 42,481 in 2025. This significant increase suggests that companies may be holding on to more stock than necessary, leading to potential inefficiencies and waste. Furthermore, a direct statement on page 45 explicitly mentions an inventory buildup, highlighting the issue as a specific concern. This inventory buildup can have far-reaching consequences, including supply chain disruptions and decreased productivity. As such, it is essential for companies to reassess their inventory management strategies to mitigate these risks and optimize their operations. That concludes the financial summary for Ascentage Pharma Group International. Feel free to comment below, and I will be happy to answer them when possible.